Welcome to MogulCast, where we uncover the stories behind the world's greatest business empires. Let's get into today's story. March 26, 2021. New York. The phones at Credit Suisse, Nomura, and Goldman Sachs are ringing off the hook. A single-family office, Archegos Capital, has just defaulted on margin calls totaling over $20 billion. In 2 days, $20 billion vanished. Not from a hedge fund. Not from a bank. From one man's personal trading account. This is the full story. And it is worse than you think. Bill Hwang wasn't always a billionaire. In 2001, he was a junior trader at Tiger Management, one of the most successful hedge funds of the 1990s. After Tiger shut down, Hwang launched his own fund, Tiger Asia, but in 2012, he was banned from trading in Hong Kong for insider dealing. Undeterred, he pivoted, quietly building Archegos Capital as a family office, avoiding the scrutiny of regulators. By 2020, he controlled over $10 billion. But there was one decision he made that would later unravel everything. Hwang's strategy seemed simple: bet big on a handful of stocks, Viacom CBS, Discovery, Baidu, and use leverage to amplify returns. But here's the catch: he didn't just borrow from one bank. He borrowed from 8. Each bank thought they were his only lender. By early 2021, Archegos had amassed positions worth over $100 billion, all hidden behind a web of swaps and derivatives. We will come back to one specific decision: it is the key to everything. By March 2021, Hwang's bets were paying off. Viacom CBS stock had surged 90% in 3 months, and Archegos' portfolio was up over 70%. Wall Street loved him. Banks competed to lend him more money, offering leverage ratios as high as 8-to-1. Hwang wasn't just playing the market, he was rigging it. But not everyone was celebrating. Behind the scenes, regulators were growing uneasy. The SEC had flagged Archegos' concentrated positions, but because it was a family office, it faced no public disclosure rules. Meanwhile, Hwang's banks were blind to each other's exposure. One bank's margin call could trigger a fire sale, but no one knew it until it was too late. Here's what the media completely got wrong about Archegos: this wasn't a hedge fund collapse. It was a leverage time bomb. Hwang didn't just borrow money, he used total return swaps, a derivative that let him control billions in stock without ever owning it. The banks loved it because it generated fees. But when the market turned, the swaps became a noose. The strategy worked, until it didn't. In mid-March 2021, Viacom CBS announced a stock sale to raise cash. The stock plunged 9% in a day. Then another 23%. Hwang's banks, seeing the value of their collateral evaporate, demanded more cash. But Archegos didn't have it. The margin calls began. March 25, 2021. 4:30 p.m. Goldman Sachs fires the first shot, a $2.4 billion margin call. Nomura and Credit Suisse follow within hours. Hwang scrambles to raise cash, but it's too late. By the next morning, Archegos is insolvent. The banks begin liquidating his positions, over $20 billion worth of stock in a single day. The market panics. The fire sale triggers a chain reaction. Viacom CBS stock drops another 50% in 2 days. Discovery plunges 40%. Banks scramble to cover their losses, but the damage is done. Credit Suisse alone loses $5.5 billion. Nomura loses $2.9 billion. And Hwang? He's wiped out, his $10 billion fortune gone in 48 hours. The fallout is immediate. Credit Suisse's CEO and Chief Risk Officer resign. Regulators launch investigations. But here's the kicker: nothing fundamentally changes. Family offices like Archegos still operate in the shadows, with no public disclosure rules. And if you've made it this far, you already understand something most analysts completely missed: this wasn't just a trading failure. It was a regulatory black hole. The Archegos collapse didn't just wipe out $20 billion. It exposed a flaw in the system. Banks had no idea they were lending to the same man. Today, regulators have proposed new rules for family offices, but none have been finalized. Meanwhile, the banks that survived have tightened their risk controls, but the next Archegos could already be building. Remember that decision we mentioned at the start? Hwang's choice to use total return swaps wasn't just aggressive, it was a loophole. By avoiding direct ownership, he sidestepped disclosure rules. And here's what it actually cost: $10 billion in bank losses, thousands of jobs at risk, and a permanent stain on Wall Street's reputation. By the numbers, $20 billion lost in 48 hours. $10 billion in bank losses. 8 banks caught in the crossfire. 5,000 plus jobs at Credit Suisse at risk after its $5.5 billion loss. 0 criminal charges filed. Archegos collapse remains the largest margin call in history, and a warning no one heeded. The lesson? Leverage is a double-edged sword. Hwang's strategy worked until it didn't, and when it failed, it took Wall Street with it. But here's the surprising insight: this wasn't just about greed. It was about opacity. Family offices like Archegos still operate with minimal oversight, and the next collapse could be even bigger. The Archegos story isn't just a cautionary tale, it's a blueprint. Every major financial collapse follows the same pattern: hidden leverage, regulatory blind spots, and a single trigger that brings the house down. If you want to understand how this pattern repeats, the next video covers a story with disturbing parallels. That one is next. That's the story for today on MogulCast. If you found this valuable, subscribe and hit the bell. A new Empire story drops every single weekday. See you tomorrow.